Hello friends. So today we are going to continue our series on a book related to stock market investing, How I Made $2 Million in the Stock Market, chapter-wise video series, and in this video we are going to see chapter 4, which is, Developing the Box Theory. When author was suffering from his crisis, then he observed that the stock market is a mysterious machine, and in this nobody cannot make consistent profits. But to bring odds in his favor he had to acquire more knowledge, like without knowing the rules of a game nobody can win, likely without knowing about the trading nobody can trade. And continued his research on the order of the Texas Gulf Producing alongside seeing the moments of a company in the market. Author remembered Texas Gulf Producing. And he bought 500 shares of that company and made a profit of $2,866.62. When he sold this he came to know that the price of this stock had gone up due to a merger. That's why author made this much of profit. He now began to try to work from this point of view and concentrated on a close study of price and volume and tried to ignore all rumors, tips, or fundamental information. Accordingly, he bought 200 shares in a company for $13,483.40. This stock starts falling, but author thought that it will rise up soon, and in just 10 days it fell down by 9 points and author made a loss of $2,023.32. After all this he started to read more books about the price movement and came to a conclusion that stocks move in a frame, and the size of this frame is decided by the high and low point of the stock, and this led to the development of the box theory. He started to see how stocks move in their boxes, and in the stocks where there is no movement he don't like to buy them. We take a one stock which moves in a box of 45 and 50, and if price of that goes to 44 then author will not like to buy it because he wanted the stocks to move to their higher box, not the lower one. For example, if this stock moved to 45 to 47 then 49, 50, 45, 47, this means that the 50 is high point of it and it moves to 46 and 47 on an average, and if it is going to move up constantly then author will buy it. Some stocks change their box in hours while some changes in days. It depends on the volume of that stock. Some stocks have a smaller frame as compared to others while some has a larger one. Stocks usually did not suddenly shoot up from 50 to 70. In other words, he considered that a stock in upward trend that reacted to 45 after reaching 50 was like a dancer crouching, ready for the spring up. He watched the behavior of a stock and saw that it is forming pyramiding boxes. When the upper frame of its last box was 59 3/4 he felt that he had assessed it correctly. He told the broker to telephone him when it reached 61, which he considered the door of its new box. It did, but he was not in his hotel room when the call came. It took broker 2 hours to reach him. By the time call came, the stock was quoted at 63 and bought it at 65. Then he came to know about the bracket order. In this orders we already decide the price at which we want to buy, and when the stock reaches that price our order automatically gets executed. Applying this theory he made $2,442.36 in next 3 orders. And in next trade, instead of reaching the targeted price it turned around and started to fall back almost immediately after the execution. He just kept saying this stock cannot go down any further, and then he learned later that there is no such thing as cannot in the market. By the end of the next week, the profit from the 3 previous operations was gone and he was back where I had started. The first step he took in that direction was to adopt what he called his quick loss weapon. Then he took the second equally important step, which was commissions, because if he invested about $10,000 and operated in a medium-priced stock, each operation would cost me approximately $125 in commission every time he bought a stock, and another $125 every time he sold it. At $250 a deal, he had only to trade 40 times without taking a real loss and had lost all his capital. He then sat back and redefined his objectives in the stock market. 1. Right stocks. 2. Right time. 3. Small loss. 4. Big profit. He examined his weapons. 1. Price or volume. 2. Box theory. 3. Automatic buy order. 4. Stop loss sell order. Along with this he decided to control his emotions. And we came to the end of the video and finished the chapter 4, and we will know more in next videos for that. Bye bye.